Hi everyone! So Tencent has published its Q1 2026 results, and for me, this quarter changes the Tencent story. In my previous video, we saw that Tencent had already started investing in AI, but the level of CapEx still looked reasonable. Even after the increase in 2024, CapEx intensity remained broadly in line with levels Tencent had already experienced over the past decade. So at that point, the AI investment looked important, but not alarming. Q1 2026 changes that picture. Tencent is now entering a heavier AI phase, and in this video, I want to discuss the pros and the cons of this strategic shift. Now, let's update the numbers with Q1 2026. On revenue, Tencent is still growing, but the pace is clearly slower. Q1 revenue reached 196.5 billion RMB, up 9% year-on-year. This is clearly not a bad number, but it is no longer the kind of broad acceleration we had seen in some previous quarters. The mix is also important. Value-added services grew only 4%, with social networks down 2%. Domestic games up 6%, and international games up 13%. Marketing services was the strongest part of the quarter, up 20%, helped by advertising demand, video accounts, and better ad recommendation models. Fintech and business services grew 9%, while business services alone grew 20%, mainly helped by cloud, AI-related demand, and mini-shops technology fees. So the top line is not weak, but it is becoming more uneven. And with group revenue growing at 9%, the next question is what happens to profit when Tencent starts spending much more aggressively on AI. The operating profit split is the important part. Reported non-IFRS operating profit was 75.6 billion RMB, up 9% year-on-year. But excluding the new AI products, Hunyuan, Yuanbao, CodeBuddy, RugBuddy, and Qclaw, operating profit would have been 84.4 billion RMB, up 17%. That number is the first visible sign of the AI cost. Without these new AI products, Tencent would have shown much stronger operating leverage. With them, profit growth is still positive, but clearly lower. Then we have CapEx. In my previous video, I already mentioned that Tencent was back in a build cycle. In 2024, CapEx increased strongly, but compared with revenue, the intensity was still broadly in line with levels Tencent had already seen in the past. Q1 2026 gives a different signal. Total CapEx reached 31.9 billion RMB, up 16% year-on-year and 63% quarter-on-quarter. And management is not presenting this as a one-quarter spike. On the call, they indicated that CapEx should increase substantially this year, especially in the second half, as more China-designed ASICs become available. So we are probably only at the beginning of a heavier AI investment phase. From there, we can look at what this strategic shift really means for Tencent. Tencent wasn't starting from zero on AI. Before this quarter, the AI effort was already there, but it was mostly embedded inside the existing businesses. In advertising, it helped with targeting and recommendation. In games, it helped with production tools and engagement. In cloud, it supported enterprise demand. And around Hunyuan, Tencent was already building its own model infrastructure. So the company was investing in AI, but the focus was still more about improving the current platform than changing the entry point of the platform itself. The shift is clearer now. The Chinese market has moved very fast, and Tencent no longer looks completely comfortable in consumer AI. Yuanbao, Tianwen, and DeepSeek have already shown that AI assistants can reach mass market usage in China. For Tencent, the sensitive point is WeChat. A large part of the group's power comes from the fact that WeChat is still the natural starting point for many digital interactions in China. If over time users begin to delegate more actions to an AI agent, that starting point can move. The flow can start before WeChat, and once the flow starts somewhere else, Tencent loses part of the control it has today over time spent, mini programs, payments, merchants, and advertising inventory. For me, this is the wake-up call. If AI agents become the next entry point, Tencent has to be present there. Otherwise, WeChat becomes less central than it is today, and for Tencent, that will be a real strategic risk. Now, we need to separate the areas where AI can really create value from the areas where Tencent may simply have to spend money to defend its position. I will start with advertising because this is probably the cleanest use case. Tencent already controls a large part of the path between attention and transaction inside Weixin. If AI improves recommendation and targeting, the same inventory can become more valuable. In Q1, marketing services grew 20% year-on-year, much faster than the group, and management linked part of that performance to better recommendation models and stronger video accounts monetization. So on advertising, the logic is quite direct. Tencent is improving a business that already works. Games are also interesting, but I would read them differently. For me, AI is less about immediate margin expansion and more about scale. Tencent already has very large franchises and a strong live service machine. If AI helps produce more content faster, Tencent can keep its game alive for longer, refresh them more often, and create more monetizable items around existing communities. Smaller studios will also use AI, but they do not have the same distribution or the same existing player base. So in gaming, AI could reinforce Tencent's domination rather than simply reduce costs. Fintech is more discreet, but there is still a practical efficiency angle. In payments, AI can improve fraud detection and risk scoring. The useful part is also to reduce false positives when legitimate transactions are blocked because the system sees too much risk. On very large payment volumes, even small improvements in fraud and approval rates can matter. I wouldn't make this the center of the AI thesis, but it is a real use case. The enterprise side is probably more promising than pure consumer AI. WorkBuddy and CodeBuddy are still early, but the monetization path is easier to understand. a company can pay for a tool if it saves time and improves productivity. The issue is whether Tencent can turn usage into recurring revenue with enough margin after inference costs. So for now, I will treat this as optionality rather than a proven profit engine. The other real advantage is data. Tencent has proprietary data from games, payments, advertising, and the Weixin ecosystem. That can become important if models trained mostly on public internet data start to converge. In that case, the difference comes from private data and real use cases. Tencent has a strong position here because its AI can be connected to businesses and user behaviors that already exist inside the group. On the negative side, I will be more direct on WeChat agents and mini programs. For me, this is mainly defensive spending, and the direct return on investment is probably negative. WeChat is already dominant, so the upside is limited. Tencent is likely spending here to protect flows it already had before, not to create a completely new profit pool. From a shareholder point of view, this looks more like an insurance cost than a high return investment. Yuanbao and consumer AI are also difficult. Usage can grow quickly, but monetization in China is not obvious. Subscription prices are lower than in the US, paying penetration is lower, and every interaction consumes compute. So a consumer AI product can become expensive before it becomes profitable. Tencent may need Yuanbao strategically, but as a standalone business, the return is still hard to see. There is also a broader risk. AI may become a standard feature. The hotel Wi-Fi comparison is useful. Years ago, Wi-Fi could be sold as an extra service. Today, nobody wants to pay more for basic Wi-Fi. AI can follow the same path in many digital products. If every competitor adds AI, users may simply expect it by default. In that case, Tencent still has to invest, but the pricing power may be limited. The hardware risk makes the equation even more complicated. AI requires expensive infrastructure, and Tencent has already indicated that CapEx should continue to rise this year. The problem is not only the amount spent, it is also the useful life of the hardware. If Tencent buys expensive chips or ASICs in a tight market, and the next generation becomes much better very quickly, part of that investment can lose economic value faster than expected. The comparison with Chinese competitors is useful here, because it shows different strategic choices. Alibaba has chosen the most aggressive infrastructure route. The company announced more than 380 billion RMB of investment over 3 years in cloud and AI infrastructure. The bet is clear. Alibaba wants Q1 and Alibaba Cloud to become one of the main infrastructure layers for AI in China. The return is not immediate, but if enterprise AI demand grows strongly, Alibaba can capture part of that through cloud usage, model deployment, and compute demand. ByteDance is also making a large AI bet, but from a different position. Its strength is consumer attention. Taobao is already one of the leading AI native apps in China, and ByteDance has a very strong base in recommendation and advertising. Reports also suggest that its AI infrastructure spending could be extremely large, even if the exact figures are less transparent because the company is private. So ByteDance seems to be making a medium to long-term bet on consumer AI, attention, and the future interface. JD is almost the opposite case. Its AI strategy looks more limited and more focused on visible productivity gains. The group uses AI mainly to improve logistics, retail operations, and supply chain execution. This is less spectacular, but the return is easier to understand in the short term. Lower costs, better fulfillment, better automation. The risk is the oversight of that prudence. If AI really changes the interface between users and digital services, JD could end up too cautious and too late. So the competitors are not making the same bet. Alibaba and ByteDance are accepting a much more uncertain medium-term return on investment. JD is looking for a more immediate operational return on investment with less strategic ambition. Tencent is closer to Alibaba and ByteDance in terms of necessity because its core ecosystem can be affected if the interface changes. But that also means Tencent is entering a more difficult investment phase, with part of the spending clearly offensive and another part very likely to be defensive with a negative direct return on investment. Now, let's come back to valuation. Tencent is currently trading around 459 Hong Kong dollar per share with a trailing PE around 15 to 16 times earnings. So compared with my previous video, the stock is now much cheaper and the market has clearly sanctioned the company after this heavier shift toward AI spending and CapEx. In my previous Tencent video, I said that any major correction linked to regulation, geopolitics, or disappointment around AI could become an opportunity. Today, I think we are close to that situation. The AI shift clearly makes the investment case more complex, and I don't want to minimize the risk. For several parts of the spending, we still don't know what the return will be. My base case is still that a large part of the investment will be defensive with limited short-term return on investment. But I still trust Tencent's management. Over the years, the company has managed to diversify the business, protect very strong positions, and allocate capital with a fairly good level of discipline. If some AI spending doesn't make sense, I don't think they will keep spending blindly forever. One detail from the call is also important for me. The larger CapEx step-up should come in the second half of the year as more China-designed ASICs become available. So Tencent doesn't seem to be rushing to buy hardware at any price. Personally, I'm still invested in Tencent with an average cost of around 286 Hong Kong dollar per share. If the stock stays around the current level, I will probably add gradually to my position. I say gradually because the main short-term risk I see now is not only the AI spending narrative, The macro environment is also fragile, especially with the war in Iran and the possible pressure on oil and LNG prices over the next few months. If energy prices rise again, that can weigh on inflation expectations, risk appetite, and tech valuation in general. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.